one, let's take a few minutes and talk about the effects of omitting and adjusting entry. We've discussed how important adjusting entries are. The last day of that accounting period is like a brick wall, and when we hit it, we have to stop and bring all of our accounts up to date. Bringing our accounts up to date ensures that we have the correct information on our financial statements. That's right. And so, why is that so important? That's so important because financial statements are what people inside and outside the company are using to make decisions. So we want the most accurate, up-to-date information. So what happens if we omit or forget to skip some adjusting entries? Well, let's look at a couple of examples. Right now, before we go on, I want you to pause the video for a second, go to Canvas to our class, and go to your Chapter 3 module, and open the file that says Information for Chapter 3 Video, Effects of Omitting Adjusting Entries. And therefore, you can follow along with what I'm talking about. So, number one that I have on our sheet, the adjusting entry for accrued fees was omitted at the end of the current year. Indicate which items will be in error because of the omission on the income statement, the balance sheet, and also indicate where the items in error will be overstated or understated. So overstated means the balance is higher than it should be. Understated means the balance is lower than it should be. Okay? So what we want to do is, let's just make up an entry. For it says it was an entry that for accrued fees. Well, we know our adjusting entry for accrued fees will be a debit to what? Oops. Accounts receivable, and a credit to our revenue account, fees earned. So let's just say that it was $1,000. Let's just keep it simple. Okay. Sorry, my writing got kind of sloppy there on accounts. Okay. So this is what we should have done, but we didn't. So, if I think about that, this accounts receivable, is an asset, and this is fees earned, a revenue. So let's just talk about the revenue first. We know that revenue accounts go on our income statement, right? Revenues minus expenses equals net income. If our revenues minus expenses equals net income, and in this entry we were supposed to increase our revenues, but we didn't, then that means on our income statement that our revenues are lower than they should be, right? I should have credited, which means I should have increased it, but I didn't, which means that $1,000 didn't get put on my income statement, which means revenues are lower than they should be. Well, on our income statement, we say revenues minus expenses. So if I'm deducting expenses from a lower than I should have been number, then that means my answer is going to be lower than it should have been. So, by understating my revenues, I am understating my net income. Letting that sink in for a second. Okay? You really have to think on these. Okay, you got to think about what you should have done, but since you didn't do it, what was the effect? So just take a second and think about it. We also need to talk about how this would affect our balance sheet. Okay, well, our balance sheet is assets equals liabilities plus equity. This accounts receivable is an asset. I should have increased that asset by $1,000, but I didn't. For whatever reason, I forgot. So if I didn't increase accounts receivable, then that means my assets are understated. Now, we know the accounting equation has to be in balance. So if something is messed up on assets, then something has got to be messed up somewhere else, okay? Well, think about it. When we do our statement of owner's equity, we add our net income to our capital to get our number for ending capital, right? So if we have understated net income, that means we added a lower number than we should have to our capital, which means on our balance sheet, equity will be understated. So man, by skipping this one entry, we messed up our revenues, which messed up our net income, we messed up our assets, and our equity. So two of our major financial statements, well, really all three of them, because the equity comes from where? The statement of owner's equity. So actually all three of them are messed up just because we skipped this one entry. Okay, let's look at another example. I know these can be kind of tough at first, but it's very, very important. This really helps you understand the importance of the adjustment process and why in reality companies spend, a good bit of time and effort making sure they gather up all this information and do it correctly. So let's look at number 2. At August 31st, the end of the first month of operations, the usual adjusting entry transferring prepaid insurance expired, which means used up, to an expense account is omitted. Okay, so we forgot to make our adjusting entry for prepaid insurance. I know that my normal entry for prepaid insurance, the adjusting entry, would be a debit to insurance expense and a credit to prepaid insurance. We learned these in the last chapter, right? In chapter 3. So I know, let's just make up a number. Let's just say it was $500 worth of insurance. Okay? So this is the entry I should have made, but I didn't. So how is that going to affect my income statement? Revenues minus expenses equals net income. And how is it going to affect my balance sheet? Well, insurance expense is an expense account. I was increasing it. And since I forgot to increase it, that means my expenses on my income statement are lower than they should have been. They are understated. If expenses are understated, then I'm subtracting a smaller number than I should be from revenues. If I'm subtracting too small of a number, then that means my net income is actually going to show up being more than it should have been, because I didn't record the fact that I incurred this $500 expense of insurance. So I am overstating my profit. I'm making my company look more profitable than it really was, which is, well, A, against the law if you do it on purpose, and B, it's going to lead you to make bad decisions. Prepaid insurance is an asset. I was supposed to decrease it, right? Credit decreases an asset, but I didn't. If I didn't decrease it, then that means my assets on my balance sheet are overstated. And we know if net income is overstated, then I'm adding too much to my statement of owner's equity, which therefore means my ending capital balance, which goes right here, is also overstated. And see, that's why these are so tricky, because it doesn't make you get an off balance. I mean, my balance sheet still balances. It's just that both assets and equity are both higher than they should be. Okay? So you can take all of our examples of any problems we've done, any adjusting entry, and you can walk through this. Please, don't be afraid to scribble and scrabble. That's what it takes, right? It helps you understand it. I don't do it just for the heck of it. I do it because I want you to know how to walk through the steps to get it. Will you always have to write all this stuff down? No. Eventually you'll be able to just read the problem and go, oh, net income's overstated, assets and equity are overstated. But for now, take your time, write it down. Thanks for watching. Let me know if you have any questions.